Greetings from Bar Harbor, Maine. My name is Charles Sidman, and I'd like to thank Richard for allowing me to speak with you today. My topic today is what I call early stage deep tech or ESDT equity. This refers to young companies that are based on sophisticated science and technology. Investments in such companies constitute a distinct asset class. They're different from the real estate, listed securities, currencies, metals, etc., that we often talk about at these meetings. But they are among the most attractive. The statistics say that this asset class returns greater than 25% per year. And the reason for that is that value is being created out of nothing. A company goes from nothing to something. Secondly, this asset class is minimally correlated with other asset classes, so it belongs in everyone's portfolio. Thirdly, it's a highly inefficient market, meaning there's lots of opportunity because everything we might wish to know, we can't know. So a lot of role for wisdom, experience, etc. Next, we are operating with disruptive changes and technologies. So a lot of bang for the buck. Some of the examples of these technologies include computers, physics, space, chemistry, genetics, other medical sciences. So what does it take to operate in this asset class? It takes two kinds of knowledge and experience, illustrated here by these two overlapping circles. First, we need background and expertise in science and technology. Secondly, on the right, we need background and experience in business and finance. And as my one personal introduction, I have both. I am a Harvard PhD in immunology. I spent over 50 years doing research globally in academic and commercial institutions with some of the best colleagues available. I worked in computer science, digital hardware, software, and AI, in behavior and neuroscience, in genetics, immunology, and other medical sciences. And as a student of evolution and complex systems, I can apply these learnings to the world of business. On the right, I have well over 20 years of experience in the business and finance arena. I've made over 100 early stage investments, mostly in biomedicine, health, energy, materials, etc. I've had a range of returns from zero, which are complete washouts, but as Jack Welch said, if you don't have some washouts, you haven't been ambitious enough, up to very rewarding 25-fold returns or multi-1,000% per year IRRs. Now, how does this look in practice? Some technology or product adoption curves show us. On the left, we have telephones and electricity and cars. On the right, we have computer things, phones, internet, tablets, etc. What they all share is starting with little adoption, increasing rapidly, and eventually being pervasive. How does that actually come about? Well, this presents another deeper view. A possibility or an idea appears as a gleam in a scientist's eye on the left. I have been that scientist. At the upper right, this technology or business has succeeded. It's affecting everybody. But in the middle, when the curve is rising at its steepest rate, that's the best place to be an investor because the most money can be made in the shortest possible time. One more look inside these curves. This is the valley of death with cumulative profit or loss on the vertical and time on the horizontal. At the left, research and development are usually funded by government. Eventually, a product is launched, still requiring more money. At some point, the product begins to succeed and more money is being earned than is being consumed. The curve bends upward. And eventually, break even happens. The business is a success. Venture capitalists tend to operate on the right-hand side of this curve after a product or a business is a clear success. But in the middle, between government basic support and venture capital support, who supports these enterprises? Angels. So I've been doing this for a long time. I've learned some lessons about how to operate successfully in this pursuit. And I'd like to share some of those lessons with you. First of all, it is both art and science, with wisdom playing even a greater role than the mechanics of demonstrated numbers, spreadsheets, etc. Secondly, like a military campaign, we have both strategy and tactics. Strategy might include which technologies or products to go after, tactics, which company, which entrepreneur, deal terms, etc. Thirdly, and here's a biggie, everyone operating in this space should have a portfolio of at least 25 investments. And the reason for that is the reality that the world will throw us curveballs. Even after we've done our homework, technologies will be superseded, people will screw up, businesses will fail. And we have to be humble enough to recognize this inevitability. Next, we have to always maintain the dry powder or the financial resource to invest further when warranted in the winners that can use it and reward us for doing so. This amounts to a search strategy, and the terms of any deal have to be appropriate to allow us to do this. This is in comparison to a one and done approach where you write a check, you hope for the best. Doesn't work in general. Next, one has to stay connected, and that's not what a one and done approach involves. You have to stay involved and connected with your companies for self-protection. You might want to defend yourself, you might want to invest further, and you might be able to lend a hand and help make the company a greater success for everybody. This was a real surprise to me. Public and private markets are often treated separately, but in the ESDT arena, they don't have to be. ESDT companies are young companies based on deep science and technology, and they appear in both public and private situations. I've had equal successes and equal failures, I have to say, from investments in ESDT companies in both public and private markets. Next, we cannot do it alone. We need colleagues, we need resources, we need experts, we need deal flow, we need exit opportunities, etc. So your network is as important as you individually are. And finally, it's a full-time and a half occupation. You can't just do it part-time or for a few hours a week. You won't get good results. Now, who's actually doing this kind of work? One constituency are accredited investors. These are defined by the government as folks having at least $1 million net worth apart from their residence. They have a lot of money in their pockets. And this investment asset class gives them a lot of opportunity to better themselves and their families' lots in life and to improve the economic landscape for everybody. But doing so, as we're discussing here, requires a lot of knowledge, effort, discipline, time, etc. And some people don't have the bandwidth or the opportunity or even the interest in devoting that much effort and time. The result is that the vast majority of accredited investors simply don't participate in this asset class, which is a real tragedy. However, the 1% in the US who do have another name. They are called active angels, and they invest their own money. They have a number of unique contributions. First of all, they are best situated to find and recruit and mentor and launch entrepreneurs from their neighborhoods. Secondly, they provide the first and riskiest outside money. After an entrepreneur has borrowed everything he or she can, used all their own resources, mortgaged their house, run their credit cards to the limit, hit up family and friends. Active angels best operate in groups to collaborate, share the work, share their knowledge and experience. And finally, angel organizations like the ACA offer wonderful opportunities for education and training. I don't know of any university in the world which has the similar offering. But angels still can't do it themselves. First of all, very few angels or groups can fully fund all the deals that they find and want to. Thus, the opportunity for syndication. Secondly, sooner or later, they have to stop participating in the later and more expensive rounds, Because the golden rule, or one version of it, says whoever has the gold makes the rules, the earlier investors often get squashed and steamrolled. Thirdly, angels are very often community focused and socially oriented. They simply don't have the allegiance or interest in even the best deals that arise in other communities. That's a shame. And lastly, because of these issues, most angels don't stay in the game. They're active and participating for 2 years or 5 years or 10 years, but eventually the returns take a long time, they wander off, and groups are therefore always recruiting new members, and the cycle starts again. Well, if angels don't do it all themselves, who else participates? Venture capitalists, you say. Well, of course, venture capitalists are professionals and they devote sustained effort. They're dealing with other people's money, so they have fiduciary responsibility. And they almost always have greater resources. But they too have issues. First of all, they are often comparing themselves to their peers, and they are thus herd creatures rather than pioneers and innovators. My background is research, understanding, and innovation. Secondly, VCs frequently, because they have a lot of money, display a certain arrogance. You have to play in their way on their terms, otherwise they don't play. Thirdly, they generally operate later in a company's development, after product or company success is clear. Thus, they don't contribute the most and obtain the best returns of participating earlier in a company's development. In fact, the average VC returns are lower than those reported for angels. Well, who else participates in this community? Many of these people are at this meeting. Family offices. They have lots of money and it's their own money. Therefore, they have great freedom of choice how to use it. But what does that choice entail? Frequently, it entails the objective. Do you want to preserve capital or grow capital or serve another purpose? And secondly, in doing this, do you want to do it yourself or to outsource the activity? The analogy I would make is many family offices have a private aircraft. But unlike Tom Cruise, who is unusual in that he flies his own aircraft, most family offices hire professional pilots. And if they have real estate, they hire professional management companies. Family offices have to decide how to operate in this field. So, given all of these players and the pluses and minuses of each, how do we put it together and do it optimally? One solution is what I represent, ECS Capital Partners. It is a fund. I'm not making a sales solicitation or offer here. And even though we are 503 organized. ECS Capital Partners is designed to synthesize the best practices and avoid the worst by and of all of the players in this ecosystem. For all investors, from the largest to the smallest, we offer a pro rata, multi-stage, and top-tier portfolio. We have individualized account structures. We're evergreen, which means that money comes in and out when you want, not when it has to in a raise or a termination. Our investors can play an active or a passive role. We are industry and finance mechanism agnostic, so we participate in private deals of many kinds, public markets, etc. We have global reach and activity and network, and we maintain our dual investment thesis of return plus impact. We feel that the greatest returns come from impactful businesses, and impact is allowed and facilitated by the greater returns. So I'd like to close with a few last comments on impact. ESDT investments are wonderful opportunities financially, but they're more than just money. You can do good and do well at the same time. All of these are beneficial and desirable impacts. In closing, I would invite anyone who wants to discuss any of these issues to email me at this email address. We can set up a Zoom meeting afterwards at your pleasure. And I thank you for your attention.